Hello, folks. Brandon Chapman with you today. It's a Wednesday edition of the TheoTrade video for January 22nd. Brandon Chapman with you, in for Don Kaufman. So I'm usually on Mondays, but Don's Wednesdays. But hey, it was a holiday and Don's a busy man, so I'm here subbing for him. Anyway, we're looking at the market. We're about 15 minutes before the close. We're near testing new all-time highs, and we have a lot to thank. Domo arigato, Masayoshi-san. Japan's SoftBank, of course, announced $100 billion investment in a new venture with OpenAI, Microsoft, ARM Holdings, Oracle, and the like, taking different duties. OpenAI taking a kind of an operational role in this to create a new AI infrastructure within the United States. And so you think about the movie Stargate back in the 90s, where they go from Earth to some foreign planet. Well, that's been our existence pretty much for the last, few decades, as a lot of foreign investment as a result of weak dollar policy has led a lot of capital flight out of the United States. Tariffs did not reverse during the Trump administration or Obama or Biden administration. Those trade deficits, because of the poor financial and weak dollar policy, leading to capital flight. Well, we're seeing today the big announcement, that opening salvo from the Trump administration, was the announcement of Stargate and the direct investment into U.S. infrastructure around AI. We can get excited about it or not, but as traders, we got to leverage the opportunity that's there. And today, that opportunity, you can see it right over here: Oracle, Nvidia, Microsoft kind of topping the list. If we look at our ARM Holdings as an example, up 16% today. And of course, we got Netflix. We'll get to Netflix here in a minute, but having a crazy good earnings announcement in terms of subscriber growth. And again, the question we have for today is, in order to travel, it takes what? It takes fuel. Do we have any fuel left in the tank? We're going to look at that here today. But again, to kick things off, huge moves from Microsoft. Again, we have earnings coming up on Microsoft as well on the 29th. We got Nvidia. Looks like they're poised to retest prior highs. They've got earnings coming up a little bit later, but Oracle, a huge gap today. They had their earnings announced back on the 6th of December, and a gap. We've just kind of made back what we've lost here. And notice that we're fading from the high. So again, as we look at some of these names, again, Microsoft holding up for the most part, Oracle not so much so, but again, ARM Holdings is another one here, trading towards the high of the session. So again, is this great news? I guess maybe not. I mean, does this necessarily lead to freedom? I don't know. I mean, this is private investment, maybe government sponsored, and trying to fuel to grease the wheels to be able to get that investment back in the United States. So at least it's kind of an opening, kind of a stance by the new incoming Trump administration. Certainly, this was kind of a big announcement that obviously it was unlikely that the Biden administration was going to put together, as referenced by Masayoshi-san from Japan SoftBank. So the idea is that, what does this mean for the market? Well, look, I mean, these are a handful of companies, and if you look at today's performance, they really were the things that were dragging the market higher. We look at utilities, real estate, energy, dragging bottom here, and everything else just middling in terms of their effort today. We've had great performance recently in energy and utilities. Makes sense you'll have a breather here. Utilities and real estate call into question, how much are we going to see really the 10-year treasury yield go down? Are we now poised to see yields start to rise back up again? If we're seeing tariffs in the near term on the horizon, does that increase inflationary pressures, among other things? If we start to see more direct investment in the United States, as referenced by the Stargate announcement, does this lead to more investment and less rate cuts and more inflation? So as we look at this, maybe there is the possibility we see this creep up, and we might be getting a little bit of an early warning sign in XLU with a rather sizable move today, down 2%, while the market was able to eke out some smallish gains as a result of a handful of companies really pushing it higher, because these are some mega cap companies. They are the elephant in the room. So as we look at the market, we want to kind of assess, What kind of near-term opportunity is here beyond where we currently stand? Again, we've gotten back to key levels. We're boxed into two large prints that we had at 604.75 and 607.62. We're boxed in this range here. Can we break out? Can we test new highs? One thing I always like to go to is the VIX, and it's not so much the level of the VIX. The VIX actually rose slightly today to 15.2. But if we look at the 3-month VIX, I like to look at the term structure. I like to see, well, what is the 3-month VIX doing relative to the spot VIX? Is the VIX kind of this structure steepening and pointing to more of a contango structure? I talked about contango backwardation in the oil market today, referenced the VIX market, so I'm bringing it up here. But what does this mean in terms of volatility expectations? So what do? We take a ratio. And you can see we finished at 1.16, almost 1.17, meaning what? Meaning that the 3-month VIX is now 17% higher than the spot VIX. Intraday, we did reach even higher. We tested about 1.185, meaning that the 3-month VIX was 18.5% above the VIX. What's happening right now is into the strength of the market. What institutions are doing, they're saying, we're expecting rising volatility in the near future. Rising volatility, given the inverse nature of the VIX to the market, suggests what? We may be in for some downside opportunity. Maybe we push higher tomorrow on the back of some of these names getting another boost over another day, but that only is pushing us to near-term extremes. And you see that as institutions are hedging at levels we've almost never seen. This is an end of day data point. We'll see where we went today, but yesterday we closed at 173. There's only been 3 other instances where we've been higher. And what this says is that the level of hedging right now, the downside risk in the market, have only been greater in 3 other points in the market history, all occurring in the last month. So while we may be celebrating today and celebrating, oh my goodness, all this money coming, oh, Netflix, they navigated the ability to add subscribers by forcing them to get off their family's accounts and friends' accounts. And they did it. They bought it, at least for a month. Well, notice what Netflix did. We gapped and we faded. We formed a bearish belt hold pattern. We start to break this low tomorrow. We may readily close the gap. So is this just a near-term boost? And we're only seeing the amount of fuel in the tank is really just fumes. And we're about to kind of reach that point where you lose steam and we start to reverse and come back to earth. Again, we've got to see a little bit as to what happens tomorrow. But again, Skew is certainly referencing yesterday, that possibility that we may be seeing the downside risk now ramping back up again. What I say all the time is when the market goes higher like this, with that high level of skew and rising volatility expectations, hey, they're comfortable with the market going up? Absolutely. Institutions are hedging their risk. Yes, but they're not bearish necessarily, right? So we're comfortable with the market going higher. Yes, as far as this can take us, it's going to take us. But here's the problem though, right? The degree of hedging eventually means we're going to see this boost reverse. We're going to start to see it initially decline and then reverse and come back to earth. We're going to start to see the labor, this very labored movement in the market with this high degree of skew really start to play out. And you look at today's range. Yes, we got the opening gap. It was only a 24-point range on the SPX. We're talking a very, very small range. Everything that goes on from here, we're going to start to see the moves get smaller and smaller until we're going to grind and we're going to start to fall, right? What we're seeing right now is the beginning of the deceleration, very likely, and then we'll see the reversal and we'll see how much that gets. But the fact that VIX is dropping relative to the 3-month VIX suggests that volatility expectations are really ramping up into this rally. And on top of that, we have a scenario developing with skew saying, hey, we've never been this hedged, expecting the downside risks to be this prevalent. The crash risk has almost never been higher. Doesn't mean we're going to get it, but it does mean, again, that it's going to cause the upside from this point forward is going to get really labored. And if you think today's range was small, we may get even tighter as we look back at prior points where we saw really elevated skew playing out, really crushing in this December timeframe, really crushing the range on the S&P 500. So as we move, that's what we're expecting. But again, are there areas of strength, right? We're seeing, again, some of these names involved, they may get a little bit of follow through. As we look at some of the energy space, right? Well, hey, this was a weak day for energy. It's been a weak few days for some of these energy stocks. They may be setting up as the energy situation is not getting better in terms of our supply. Look for some of these pockets of strength developing. One I was watching for was Apache. We played this off the low down here because of option activity. And now we're looking at today. We kind of faded off the high a little bit. We start to trade through the high. We're looking at potentially getting back into producers, oil and gas producers like Apache and others, a Devon Energy, and some of your integrated names like a Chevron that pays a good dividend. We had a 165 target in here. We talked about buying as protected put going in the earnings. We got to watch for that. But again, there's areas that may come out. If the market starts to get a little soft, utilities could start to perk up. But again, we're seeing the weakness here really portending or pointing to the potential that 10-year treasury yields may be looking to back up here as the TNX may be finding some support or resistance in price, support and yield. And we could see a little bounce here. And a bounce towards 5% may create additional pressure for the market, whereas right now we're only seeing some near-term strength. And of course, gold. Gold's one of those where we played a spread, a 250, 252, talked about cutting that loose yesterday at a 73% gain. Well, look, we're bouncing. We're up today again. Gold is reaching the end of its seasonal trend higher that I've been talking about for a month. So we got to be careful as gold gets stretched. Yes, we've seen the dollar weaken a little bit in terms of the euro. We've seen a pullback here. Does the dollar, again, on this news of some foreign investment in the U.S., does the dollar start to perk up just a little bit? It may be the cleanest dirty shirt out there as we consider the the euro/US dollar. We may see some resistance here at 104.50. We could see this pull back. We could see the dollar strengthen. We could see a backup in treasury yields and see that rise. And again, could create some pressure on the market. So this is a point where, hey, if you've got some good profits, as I've kind of walked through the last week in several energy and not utilities, but gold trades, for example, this may be one of those times where you're looking to take some of those profits into the strength, still maintaining a bullish bias, but softening that approach a little bit. And because we're kind of resetting that 5 to 10% potential downside move as that 3-month VIX may be pushing towards 20% higher than the spot VIX. And if we move higher tomorrow, that only kind of pushes it very likely up in that territory. So my take on it, we're losing fuel. We're running on fumes right now. And again, if we edge higher, we're looking at smallish moves to the upside. So just be selective, look to take profits into strength. That's all I've got for today. I'm out. We'll see you back on Monday. Thank you.